There is a case for no rate cuts this year. If the break-evens are moving higher, if the narrative is that inflation is not as under control, well, it's steady, but it's just not slicing down to 2%. So does that build on the argument that you could have 3 or less rate cuts this year?
Yeah, so our base case has been all along 50 to 75 basis points of cuts, so modulating rates lower. But I think what is highlighted by what Torsten's saying is that the market continues to lean really the other way, right? So the bias in this marketplace is much more dramatic rate cuts, right? And you saw where we were at the beginning of the year. You see it when any kind of swoon in the marketplace, the market instantaneously prices in a dramatic rate cut environment. And that just doesn't hold in our estimation, given where inflation is, given where growth is. So I think what Torsten is really just highlighting is that the risk in the market is that they don't cut at all, because the market has continued to lean into this notion that you will see rate cuts in even more than 50 to 75 basis points. So that's the bias.
How much of a risk, Greg, then would that be to the bond market? 10's trade at 422 this morning. Given the narrative that we've just discussed, would that be materially disruptive to rates? Would it be 4.5%? Would it be 5%? And would you be a natural buyer on those riff higher?
Yeah, so I think it pushes everything higher for sure. So if you don't see rate cuts coming in, the front end will continue to adjust higher, which will move the entire curve higher. But you'll still continue to have this inverted curve, at least as tens, 2s, 10s, and 2s, 30s. So the market will continue to kind of have this inversion being priced in, which is to say they're not really buying into the notion that, we won't have rate cuts at all. So I do think there's a repricing. I think it'll be a gentle repricing, but it's really about what the data says behind it.